Headlines are loud, but the numbers are louder. Beijing just greenlit a $285 million push into Brazil's trade arteries, logistics, ports, credit lines. The plumbing that actually decides who feeds China, who fuels its factories, and who gets left standing outside the largest buyer's door. Overnight, contracts that U.S. exporters counted on for soy, corn, beef, pulp, and even LNG were suddenly in play. This wasn't a press release stunt. It was a lever. Move the lever in São Paulo, and the pressure shows up in Iowa, Nebraska, and Texas. If you felt the ground shift, you're not imagining it. Global demand didn't fall. It changed lanes. The design is simple and devastating. Fund the bottlenecks that slow Brazil down, and you change who wins the next decade. A few $100 million aimed at the right choke points. Grain terminals that load faster. Rail spurs that cut trucking times. Storage that reduces moisture loss. Translates into billions in pricing power. Lower friction means Brazilian soybeans clear ports sooner and land in Chinese crushers cheaper. When a buyer like China can shave days off the journey and dollars off the ton, loyalty isn't sentimental, it's arithmetic. Washington can argue geopolitics. Traders mark delivered cost. For years, exporters survived on reliability. Even when prices were tight, America could guarantee consistency, insurance, financing, and standards. But logistics is an arms race now, and Beijing is underwriting Brazil's upgrades like a hedge fund playing the spread. You don't have to outspend the United States. You only need to out-optimize it at the point where contracts are priced. That's what this $285 million really buys. Not headlines basis point. It buys faster turnarounds at berths, synchronized rail-to-quay handoffs, and the kind of data visibility that lets a buyer squeeze every middleman in the chain. There's a financial layer too. The package leans into UN settlement pilots and trade finance that doesn't rely on the dollar. Brazil gets smoother access to credit and hedging tools tied to Chinese demand. Chinese buyers get insulation from currency whiplash and sanctions risk. US sellers lose the structural advantage of dollar liquidity, those comfy low-friction letters of credit that made American shipments plug and play. Once a few big Brazilian contracts settle in RMB without drama, the habit forms, and habits in commodity trade are like concrete. Wet for a moment, then hard for years. Listen to the knock-on effects. If Chinese crushers can lock in Brazilian volumes with better turn times and cheaper financing, US soybeans become the swing supply, the backup plan, not the baseline. Swing suppliers live on thinner margins and shorter notice. That means more volatility for farm incomes, more stress on co-ops and processors, and less leverage with shippers and insurers. The story repeats in beef and poultry feed, in orange juice and pulp and cotton. Where Brazil can match quality, logistics decides the winner, and Beijing just paid to make logistics choose Brazil. This doesn't happen in a vacuum. It lands in a geopolitical moment where tariffs, counter-tariffs, and chip bans are already scrambling supply map. Washington talks resilience. Beijing builds alternatives. While politicians trade podiums, buyers and sellers trade routes. When the world's most formidable importer funds your competitor's throughput, that's not a talking point. That's a permanent option against you. It shortens the distance between Brazilian fields and Chinese tables, and lengthens the distance between US lobbyists and outcomes they can actually control. In Brasilia and the state capitals, the mood is pragmatic. Brazil doesn't have to pick sides when it can pick contract. Investment that fixes freight costs is apolitical at home and unstoppable abroad. Governors see rail concessions that finally pencil. Port operators see utilization rates that justify the next berth. Farmers in Mato Grosso see premiums that used to vanish in potholes reappear in their balance sheets. Once those gains register, Brasilia will defend them, whoever occupies the Planalto Palace. This is policy by performance. The projects that work become the politics you can't cancel. Now zoom out. US trade negotiators can propose new frameworks, but frameworks don't load a bulk carrier in 12 hours. Instead of 24. Farm states can plead for reopened markets, but pleadings don't replace a buyer who's already booked 3 seasons of Brazilian supply with rail priority and currency terms baked in. The uncomfortable truth is that a focused $285 million properly targeted can cascade into multi-billion-dollar realignments, because commodity chains are geared systems. Touch the right gear, the one with leverage over time and cost, and the whole machine turns. Wall Street is already pricing the shift. Fertilizer names with Brazil exposure perk up. Shippers tied to northern arc routes see volume signals. U.S. processors whisper about tightening margins if origination shifts south. This isn't panic, it's reprice. Analysts love to argue it's only a few $100 million, but spreadsheets don't care about absolute spend. They care about throughput per dollar and predictability per day. If the payback is measured in fewer demurrage fees, higher grain elevator turns, and smoother customs cycles, the IRR writes itself and the capital keeps following. For U.S. policymakers, the temptation will be to answer politics with politics, investigations, tariffs, demands on allies. But the battlefield has moved. You don't counter logistics with rhetoric. You counter it with logistics. That means hard, boring fixes. Permitting that doesn't take a geologic app. Dredging that keeps draft where it should be. Rail priorities that align with harvests. Inland waterway upgrades that don't wait for a crisis. It means aligning finance to make long-tenor infrastructure loans. Pencil for ports that have to compete on hours, not just patriotic press releases. And for U.S. producers, the message is sharper still. The buyer is telling you in capital, not words, that Brazil is their base case. To stay in the game, America needs to make itself the low-risk, low-friction alternative. Again, impeccable quality control, superior traceability, carbon accounting that withstands scrutiny, and delivery windows that beat the weather. If you can't be cheaper, be fast. If you can't be faster, be safer. Build the story that makes your contract worth the premium. When the buyer's spreadsheet says Brazil by default, there's also the psychology of markets to reckon with. Once traders believe that Chinese policy will continually sweeten Brazilian lanes, more sidings, more storage, more cranes, the expectation itself suppresses U.S. pricing power. Buyers will demand Brazil plus terms from everyone. That changes how merchandisers write options, how insurers price risk, and how banks collateralize inventory. A single well-aimed round of investment can tilt the forward curve for seasons, because it changes what counterparties expect to be true about time, risk, and cost. Is there a path back? Yes. But it starts with admitting the loss and choosing the fight you can win. You won't out-subsidize China in Brazil, and you won't talk Brasilia out of upgrades that enrich Brazilian produce. What you can do is modernize your own corridor, so thoroughly that when drought or strikes or politics hit South America, and they will, America isn't just a fallback, it's the standard. Pair that with smarter trade diplomacy that diversifies buyers beyond a single import behemoth, and retools export credit to make small and mid-sized producers competitive on terms, not just tonnage. In the end, this $285 million isn't about generosity to Brazil or hostility to the U.S. It's about optionality for China. In commodities, the side with more options writes the rules quietly, one bill of lading at a time. Beijing just bought options that pay out every harvest. If Washington wants to answer, it has to build options of its own, cranes and dredgers, not slogan. Because the next time a buyer in Shanghai clicks confirm, the algorithm won't ask who gave the speech, it will ask who gave the ship a faster berth and a safer sail. And that's why billions at stake isn't a scare line, it's a balance sheet preview. If you sit in a farm office in the Midwest, in a shipping brokerage in Houston, or in a policy suite in DC, the consequence is the same. A low-cost, high-reliability competitor just got cheaper and more reliable. You won't fix that with a here. You fix it with steel in the ground and time off the clock. Until then, contracts will keep sliding south, and the world's biggest customer will keep rewarding the lanes that respect its calendar, its currency, and its calculus.